Hey, I'm Paul Rabelais, and in this video, we're going to address whether life insurance proceeds are tax-free. Probably not as simple an answer as you might think. So I'm Paul Rabelais. I'm an estate planning attorney. Over the years, I've had to address many times the tax consequences of life insurance and being the beneficiary of a life insurance. And I'll start by saying, many people they start with just this general statement that life insurance is tax-free. So sometimes I'll be sitting, across the table or a round table with a couple who's getting their estate legal program in order, and I'm helping them do it. And maybe the conversation might turn to tax or even estate tax, and I'll ask the question. So tell me a little bit about what you own. And they might tell me about their house and their property, maybe even a vacation property, maybe some investments, IRAs, retirement accounts. And then I might ask the question, do you have any life insurance? And many times I get the response, yeah, we have some life insurance, but we don't have to worry about that. That has a beneficiary, that's not taxable. So then I don't physically roll my eyes, but inside my brain I roll my eyes and I'm like, okay, here we go. We got to have the old, when is life insurance tax-free conversation. All right, so in this video, and now you're going to start to see some of the differences, we're going to address whether life insurance is subject to the income tax or the federal estate tax. Two different sets of rules, completely different. All right, so first let's go over the income tax consequences of life insurance. And I'll just say in ordinary circumstances, life insurance proceeds that are payable to a beneficiary or beneficiaries are income tax free. So let me just give you a couple examples. Husband buys a $500,000 life insurance policy. Policy is in his name as the owner. He names his wife as the beneficiary. The husband is the insured. He dies. Life insurance company pays his wife, gives her a check, $500,000. That is not taxable income to the wife. Same thing. Husband has maybe 3 adult kids, and he wants, or he owns a policy and names his 3 children as equal beneficiaries. He dies. Life insurance company pays each child $100,000. The children don't pay income tax on that either. Or maybe maybe parents have life insurance. They have minor kids. Parent or parents pass away, and really it should have been set up to go to a trust for the minor kids. Still no income tax consequences to anyone. There are a few exceptions, and then there's just the if the husband has $1 million policy, it doesn't really matter what the value is, and he dies and the proceeds go to his wife, and it takes her a few weeks or months to actually get the money because she's got to get a death certificate and she's got to do a bunch of paperwork, and maybe $5,000 or $10,000 of interest accrues on that $1 million after the husband dies. Well, that interest that she gets paid, she'll get a check for more than $1 million, and that interest that she gets will be subject to income tax to her, but that's just a small amount in the overall scheme of things. So in general, life insurance is income tax free to the beneficiary. Now we got to get to the estate tax, which is a completely different set of rules. And so let's start with that. This is really just going to be a life insurance estate tax 101 conversation. But it's an important conversation because the estate tax rate is 40%. And a lot of people are out there right now thinking, I don't have to worry about the estate tax. My gosh, that estate tax exclusion, I wish I had to worry about the estate tax because the estate tax exclusion amount is $11.58 million for people who die in the year 2020. So I wish I had that problem, but I don't, because all I have is I have my, I've been working hard, and I have all my property, my investments, my retirement accounts, and it's about $4 million, and then I got another $3 million of life insurance. So you add all that up, even if the life insurance is part of my estate, it's $7 million and way under the $11.58 million that somebody can have. However, the estate tax is scheduled to what's called sunset on January 1st, 2026. the estate tax exclusion amount will essentially be cut in half, and it'll come down, and we don't know exactly what the number will be because it gets adjusted for inflation, but it'll be about $6 million starting on January 1st in 2026. And most of the people who are putting their legal affairs in order right now in 2020 when I'm making this video, many of those are still going to be alive in 2026. So with the estate tax exclusion amount essentially being cut in half, unless Congress changes the rules, and which they are likely to do, or they are susceptible to doing, then the estate tax exclusion amount is going to be cut in half and more estates will be subject to estate tax. All right, so because of that, you really need to understand the estate tax rules as it relates to life insurance. Okay, so here's the deal on life insurance. Is it subject to the 40% estate tax? So life insurance, on your life is going to be part of your estate for federal estate tax purposes if you, I guess the informal word thrown around is if you own the policy. But technically under the IRS regulations, the IRS says life insurance, the death benefit, is part of your estate for federal estate tax purposes if you have any incident of ownership in the policy. Kind of the same thing. If you own the policy, you're going to have these incidents of ownership. But nonetheless, an incident of ownership is a thing like the right to change the beneficiary, the right to surrender or cancel the policy, the right to assign the policy, the right to revoke an assignment, the right to pledge the policy for a loan, or the right to obtain from the insurer a loan against the surrender value of the policy. So all those are considered incidents of ownership, which in general an owner is going to have all of those incidents of ownership. So if you have life insurance on your life and you are the owner of the policy, and every policy has three parties: an owner, an insured, that's who's the person that when they die the life insurance is going to pay, and then every insurance policy has beneficiaries, who gets the death proceeds when the insured dies. Okay, so the deal is if you own the policy, then it's part of your taxable estate. Let's dig a little bit deeper and talk about when life insurance goes to spouses or kids. So it is common, I'll use the example, I used it before, husband, let's say he has $1 million policy and it's payable to his wife and he's the owner. And so he dies. Does he have incidents of ownership? Yes, he does. He's the owner. Beneficiary is his wife. Now, because, let's use bigger numbers. Let's say he has his non-life insurance assets are $4 million. His life insurance is $3 million. His gross estate is $7 million. You would think there'd be some estate tax due when the estate tax exclusion amount reverts back to $6 million. However, when any bequest or anything left to a spouse for estate tax purposes falls under the estate tax marital deduction. So he had named his wife as the beneficiary of 100% of the policy. So after he died, she gets the $3 million. Yes, he was the owner and had the incidents of ownership in that $3 million policy. It is included in his estate, causing his estate to go up to $7 million. His gross estate is $7 million. However, but because $3 million of that went to his spouse, that qualifies for the estate tax marital deduction. So while his gross estate was $7 million, his net estate subject to estate tax is $4 million. If the exclusion amount is $6 million, there's no estate tax when he died. Now, that $3 million went to his spouse or his wife. That's all going to be part of her estate when she dies, unless she spends it, which she might. But so it really just kind of defers the tax until the surviving spouse dies. In normal circumstances, when she dies, if she hasn't spent it, she'll leave that money to her children, and that will be part of her estate subject to estate tax when she dies down the road. So I'm trying to make you aware of this estate tax marital deduction when assets, including life insurance, are left to a surviving spouse. The estate tax marital deduction doesn't apply just to life insurance. It applies to any assets left to a surviving spouse. So that helps when the first spouse dies and that spouse leaves life insurance to the surviving spouse. Then the other situation, which is common, is a parent has life insurance that he wants to leave to his kids. That's a different story. $4 million of non-life insurance, $3 million of life insurance. Dad dies. He's leaving everything to his 3 kids. No spouse to take advantage of the estate tax marital deduction. So that's $7 million. If the estate tax exclusion amount is $6 million, then you got $1 million more than that. Apply 40% to $1 million. There's going to be $400,000 of tax due. So in those circumstances, what is often done is maybe if the children are adults, maybe he should have made his children the owners of that policy so that the children are the owners and the beneficiaries. He's just the insured. Dad doesn't have any incidents of ownership. So he dies, the $3 million of life insurance goes to the kids. There's no estate tax. That $3 million is not part of Dad's taxable estate. What's more common than naming the children as the owners is naming what's commonly referred to as an irrevocable life insurance trust, or ILIT, making a trust both the owner and beneficiary of that policy. And so it allows dads, sort of to have more control over that policy because there's probably going to be one trustee, and the 3 children won't be co-owners of the policy. They'll just be equal beneficiaries of that trust to receive those proceeds when Dad dies. So real common when things are set up for the kids, especially if the purpose of the life insurance is to avoid estate tax, and especially when those proceeds perhaps are designed to be used to pay the estate tax on the remaining assets that are in the estate, then having all that structured the right way becomes important. And structuring it when the policy is acquired is really important versus acquiring it in your name and then having to transfer ownership of it later. You get into all kinds of gift tax consequences when you do that. So that's the deal there. We went through pretty quick. In general, income tax, life insurance free of income tax. Estate tax, 40% estate tax. The big exemption is going to sunset in 2026, and the exemption is going to be smaller. It's going to create more people and more estates being subject to estate tax. If you have an incident of ownership in a life insurance policy on your life, it's going to be part of your taxable estate, subject to the 40% estate tax, if the combination of the life insurance and the other assets that you have cause your estate to be over that exclusion amount. Okay, so that's enough on that. I do want to encourage you to hit the subscribe button and the notification bell. That way you won't miss anything. And then if you give it a thumbs up, that'd be fantastic. And then even if you want to do me another favor, hit the share button and share this with other friends, colleagues, neighbors, whatever, people on your texting list or email list. That would be awesome. And I'll keep, as long as I can keep communicating and keep sharing this message and people are seeing it, I'm going to keep making these educational videos really on a daily basis. Check in at 10 a.m. Central Time, and we'll keep it going. All right. Y'all have a great day. See ya.